Over the past few weeks, Hycroft Mining has been one of the most exciting stocks to trade in the stock market, as its price grew by more than 500% during that period of time. In this video, we're going to talk about Hycroft Mining Corp, trading under the ticker symbol HYMC. At the moment, the financial market is very volatile, and we should be careful about which stocks to buy and the exposure and the timing of our trades. This video will cover the recent price actions and the technical aspects of the stock. Before it begins, a quick heads up that my analysis is usually based on sessions already completed, and that if there are significant events occurring after the fact, I will make follow-up videos to reflect them. That being said, let's begin with today's topic. During the most recent trading session, the stock increased to $2.10 before closing the trading day at around $2.05. We should pay attention to the $2 level nearby because it was tested as a significant support level that seems to stabilize the retracement of HYMC stock price. And if it manages to actually hold the price there, it would mean that the baseline for the stock would be even higher for later takeoffs, which would be an excellent news for us. Over the past 30 days, the trend of the stock has been clearly bullish, as the stock is now following a typical pattern for uptrend price actions, with occasional retracements and pullbacks followed by new highs. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock is bullish, with a significant increase in demand in the perspective of seeing large gains from short squeeze and the company's own fundamentals. Of course, that's not always the case, as we're going to see later with the volume traded. Sometimes the volume is much lower than the average, and this is also very typical with retracement and pullback periods. When we look at the price trend overall, it's been speeding up because the company is gaining momentum with its price action, which would become a self-fulfilling prophecy of increasing the share price if the volume increases as well. The current trading volume of Hycroft Mining is 35 million shares, versus an average volume of 145 million shares. Over the previous 52-week period, its price fluctuated between 28 cents and $4.37. The market cap of Hycroft Mining is currently at $130 million versus the enterprise value of $229 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that a company can generate more profit or grow faster than its competitors, because the assumptions may be that this company has a better management, a stronger brand recognition, or a bigger online following. It is what makes one company in particular unique compared to alternative competitors. In other words, it may not be a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount. Because the market cap may be lower than the enterprise value, because the enterprise value is less reactive in very volatile situations. If the company goes to liquidation, the goodwill would be significantly depreciated, and we would be left with potentially less assets to distribute to shareholders and debt holders than what we currently see on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 568% higher than its 1-month low, 568% higher than the 3-month low, and 568% higher than the 52-week low. On the options market, which also gives us a hint about the market sentiment on where the stock price is likely going to head toward next, the implied volatility is 210%, compared to a historical volatility of 475%. The put-call volume ratio is currently 0.07. It's normal for most stocks to also tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 27,000 contracts in a day compared to the 30-day average of 43,000. In terms of open interest, the most recent volume of open interest is 281,000 contracts versus the 30-day average of 103,000. In terms of shareholder structure, institutional shareholders own about 18% of the outstanding float. The biggest shareholders include White Box Advisors, Nomura Holdings, and Vanguard. It is relevant to understand the shareholder composition of a company as this helps to determine if you should be holding the stock in the long term or to view it simply as a trade opportunity. If the stock is mainly held by retail traders, this can be a sign that it lacks the depth to justify long-term holding. Typically, the consensus is between 25 to 30% of institutional participation. Obviously, there would be a lot of exceptions, since many great titles are also held mostly by retail investors, but that tends to be the exceptions and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, this is a sign that there's an organized shorting operation that is going on. The current short interest is 30% of the total volume, and approximately 40% of the transactions are dealt outside of the exchanges, and this, in my opinion, means that something organized is going on aiming to short HYMC. In other words, the profit potential for HYMC is even higher as we speak. Overall, my opinion on the Hycroft mining is bullish, with very significant demand and price increases within a short period of time, suggesting that the momentum would last for some foreseeable future, with a potential gain that could be huge. The maximum exposure I would recommend is between 1 to 3% of your portfolio. For your immediate term, the recommendation is to buy the stock considering the recent price actions and the price levels nearby. I would also separate the allocation in batches of 20% at a time so that you can have enough room for later purchases. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.